Since the turn of the millennium, the United States' debt load has increased significantly, with some individuals worried about the country's long-term financial stability. But whose debt is all of this? The total quantity of bonds that a country has issued or sold makes up its overall debt. In the second quarter of 2022, the total amount of US debt was close to $30.6 trillion. Other governments and central banks are the biggest holders of the US Treasury securities. Be sure to keep watching till the end of the video to learn why China sold all of its assets to destroy the USA. Welcome to Proactive Investing. Before we get into the video, please smash that like button and subscribe to Proactive Investing to never miss the newest content about investing and economics. US government debt totaling $1.17 trillion is held by China. Economists and investors are concerned that, in the event of a trade war, China would lower its holdings of US debt as a political tool against the Trump administration's proposed tariffs. In that case, the value of the dollar may decline and other nations might follow suit and sell their assets. A collapse in the bond market could result if China stops buying just as the United States is putting more new treasuries on the market. Both China and United States suffered economic losses as a result of the trade conflict, which also prompted trade flows to divert from the two countries. The Washington Posts have long noted that, quote, US economic growth slowed, company investment frozen, and corporations didn't hire as many people. Many farmers across the country filed for bankruptcy, while the manufacturing and freight transportation industries saw lows not seen since 2008 to 2009 recession. The tax rises as a result of Trump's actions were among the biggest in recent memory. End quote. China has purchased many government bonds during the past few years, partly because it has US money on hand that needs to be spent. Like any investor, China wants to invest some of the dollars it has earned from exporting goods to the US in secure assets, and US bonds are the safest option available. Most of the time, China, which has held on to almost $1 trillion in US bonds for several years, has retained these assets, earning billions in interest payments. In order to counteract a rise in the yuan, it sold some of its assets in late 2016 and early 2017, but most of what it sold was already been purchased. According to Jeff Mills, co-chief investment strategist at PNC Financial Services Group, if China does decide to sell off those bonds in a fit of wrath directed at President Donald Trump, it may have a catastrophic impact on the global markets. He answered, they could surely accomplish that. He says interest rates and bond prices would be the two areas that would be most affected. Fixed income prices would decline and rates would increase if China oversupplied the market with treasury bonds, increasing the supply of US bonds. The cost of borrowing would increase the government's consumers and businesses if rates rose, which would limit the growth of the American economy. Additionally, the cost of issuing debt for the US government will increase because of the need to charge borrowers higher interest rates, while the value of the $15 trillion in treasury securities held by the government and investors will decrease. Stock market shares would fall as interest rates rose. A rise in interest rates, according to Mills, would have an impact on the entire economy. A slowing impact would result. Although a sizable 20% of the US debt is held by foreign nations, China only makes up around 5% of the total amount of the outstanding debt. Other holders include the US government, businesses, and investors. Japan alone holds roughly $1 trillion in treasuries. According to Vincent Reinhardt, chief economist and macro strategist at BNY Mellon, if China does decide to sell its treasury securities, it may cause other countries to panic and do the same. A sell-off would have a significant effect on its own financial concerns, so President Xi Jinping would have to be quite enraged to dump treasury bonds in large quantities. Reinhardt compares it to having a gun pointed at one's head and declaring a hostage situation. China would probably have to sell at least some of the treasury securities it bought at a loss if it were to liquidate its bonds holdings. It may lose billions if other nations sell as well and the commodity's price falls. According to Reinhardt, it will cause itself capital losses. So what do you think about the situation so far? Comment down your thoughts below. If you're enjoying this video so far, please like this video and subscribe to Proactive Investing right now. Mark Zandi, the chief economist at Moody's Analytics, adds that if the US dollar declined as well, this trade-related provocative move would be somewhat immaterial. The value of the dollar would fall, increasing the appeal of American products at the expense of China's own export market. It would lessen some of the effects, he claims. What would be the overall effects of rates rising but the dollar falling? It isn't a winning approach. Furthermore, according to Mills, it's doubtful that selling treasury bonds would make up such difference. Interest rates could remain steady if other nations step up to acquire those treasuries. Currently, when the world economy falters, people and nations still view US bonds as a secure investment. There is no reason why demand wouldn't materialize if that continues to be the case. According to Mills, demand for US Treasury bonds have mostly stayed the same. Quote, "I would imagine that if they did start to sell, there would be a considerable amount of demand from other countries and US firms, especially as rates slowly grow, making them more appealing holdings." End quote. According to Reinhardt, China might exercise more restraint and refrain from purchasing new bonds as existing ones come due. The supply would then gradually increase and possibly push rates to a more extreme levels as the United States reduces quantitative easing-related asset purchases. So other choices for China are: Zandi believes that China has different options for expressing its unhappiness. It might weaken its own currency, making exports even more alluring and widening the trade gap that Trump has raged against. That would undoubtedly enrage Trump, he claimed, and cause havoc on the financial markets. He said it would cause some serious agony. They might also make it harder for Americans to obtain visas or even take over companies with headquarters there. Quote, "You conduct operations here. Too unfortunate. They are now ours," he remarked. "They may make things very challenging for someone wanting to conduct business in China." End quote. It's hoped that everything will blow over before any harsh actions are taken. We're on uncharted ground, so it's impossible to predict how these two global giants will respond in the future. While Mills asserted that China, with its substantial manufacturing job base, needed the United States more than the United States needed them, Reinhardt believed that the United States ultimately wouldn't do anything to harm its own economy. Zandi claims that even though there may be a back and forth argument, the responses will be proportionate. Regardless of what occurs next, all of this is problematic. He declared, "This isn't going to end in a place that's better for anybody. There will be no good news from this, even if everyone manages to save face." China makes loans to the US so that the US can continue purchasing the commodities China produces, which practically means that US debt offers the safest haven for Chinese foreign exchange reserves. Therefore, China will keep accumulating US currency and US debt as long as it maintains an export-driven economy with a significant trade surplus with the US, and through the acquisition of the US debt, Chinese loans to the US make it possible for the country to acquire Chinese goods. Both countries stand to gain from the circumstance, making it a win-win scenario. China gains a sizable market for its goods, and the United States profits from the low cost of Chinese items. In addition to their well-known political competition, both countries are entangled in a mutually beneficial interdependence that is likely to persist. Treasury prices would drop, and rates would increase if China decides to cease buying or decided to even sell a tiny portion of its proposition. Higher rates would inevitably lead to weaker economic development and more expensive borrowing for the US government. Some people believe that China's sizable treasury position makes the United States economically susceptible to foreign governments' decisions. Until you consider why China purchases so much US debt, this can look like a possible risk. China purchases treasuries to help lower the value of its currency, the yuan, even though the explanation can be somewhat complex. The country's export-based economy continues to grow due to the weaker yuan's ability to make goods cheaper for international consumers. Therefore, if China suddenly stopped purchasing US debt, the Chinese economy would suffer just as much, if not more, than that of the United States. And that concludes today's video. Leave your thoughts in the comment section below, and as always, subscribe to our channel and hit the bell icon so that you won't miss any more videos. Thank you for watching Proactive Investing, and we'll see you next time. Until then, ciao.